Hey everyone, it's Imran from Options Insight, back with another macro options spotlight.
Remember, like, subscribe, comment. Wanna get this all over the place.
Okay, what's been going on? Last week, markets closed out the week pretty weak on the back of non-farm payrolls coming in way stronger than expected with a 5 handle on it. And then ISM services also coming out a lot higher than expected, around 55. That keeping pressure on the Fed to do more, taking terminal rates back above 5%. After the dovish reaction we had seen to Powell's presser on Wednesday, that kind of now reversing to some extent in terms of the rate pricing. Commodities also crumbled. We saw gold down nearly 2 sigma on the week. Big move down. We've been calling for that for a while, as you're aware. Finally seeing that slice through 1900 support level. Copper also, we were targeting $4, a test back down at that support, and that's hovering around those levels now as well. So we don't know if the metals pullback is done now or it's got room to go. A lot's going to depend on the dollar, but we had been calling for it, and this was the catalyst to make that happen. Oil also had a bad week down 7%. As that China narrative also takes a breather. Chinese stock markets down around 6% on the week. Volatility not actually as big as you might have thought, given the reversal that we saw. So if you see here, we've got 16.5-ish on S&P Vol, only small up on the day there, slightly higher on the week. That's basically spot higher, vol higher. Seeing that spot higher, vol higher dynamic is something that's fairly rare. The VIX spiking alongside spot markets. And we think that was partly because there was a massive VIX call option buyer that we mentioned on Friday in the March 23 expiry on the 24 and 26 calls, buying ridiculous volume, 300,000 options, which is like a day's worth of call volume. They did it in 2 clips. They're just hoovering in a lot of options, and that obviously creates a need from dealers to buy the VIX. And that's why the VIX really couldn't go down, even though the market was initially rallying. Commodity vols have softened as well. We saw a little bit of bid come back to oil vol, but outside of that, generally softer vols in commodities, as the carry in commodities has been green and pretty positive for a while. Carry-wise, gold flipping to deep negative there, where implies are at 13.5, but realize spiked up to 20 in the violent sell-off that we've seen. US stocks also flipping to negative carry. Less positive carry in Europe than we've seen lately. And the only thing that really providing decent carry in equities is the Nikkei, because the yen has kind of stabilized in that low 130 region. And those JGB yields have ticked back towards around 0.5. So that's kind of been behaving itself recently. There was some talk about Kuroda being replaced by a relatively dovish successor. And that's kind of kept that market in check for now. Okay. Talking a bit more about the dollar, obviously staging a pretty ferocious bounce in 2 days, recovering about a month's worth of weakness there. So very much the dollar trend was intact on the downside, and there was some pain that needed to be felt, and markets reversed. That's pretty much it for the summary worth mentioning. If we then look at, I've said strong payrolls trigger a pain trade. So the big surprise was obviously payrolls coming out way above expectations. As all these tech job losses that we've been seeing, everyone's expecting to see that in the data, and it hasn't really happened yet. Now, the interesting thing is the household survey, which has shown there hasn't really been any job gains for God knows how long. In contrast to non-farm payrolls data, the household survey also saw a major improvement this time around. So it's hard to really ignore that. And where a lot of people say the non-farm payroll is distorted by birth-death rate assumptions, we can't really say that about the household survey. So the fact that came in strong is telling. The market reaction, obviously, to the print was a continuation of the dollar bounce that had started after the dovish reaction to ECB and Bank of England the day before. Now, the great start in 2023 that risk assets have had in general looks like it's time for the market to inflict some pain on that. And we know markets love to come and seek out the pain. So as such, we're likely to see many of the crowded trades that have come in early this year get tested. Okay, so if this dollar bid can remain, then the type of things that we expect to get tested are EM assets. EM assets have seen massive inflows, you can see from the chart here. So we'd expect there potentially to be some weakness in EM that can flush out some of that positioning. Clearly, Euro positioning has got itself very long. We've been talking about that for weeks. And we've already seen that violent reversal from above 110 back down here to below 108. but don't be surprised if we even test as low as 105, 106 to flush out some of this euro long positioning that has become a bit consensus. And then lastly, gold. Gold longs obviously have been accumulating as well, and we've seen the move down. Who knows if that's enough pain if trying to come in and buy the dip again. Gold can rally, but we do think that is another one of those crowded trades that seems to have got a bit consensus. So I'm still favoring some potential more unwinding in there. I am actually long some gold puts that I've had for a while. I haven't sold them yet. So looking to hold, I mean, they do expire in about 11 days. So it's kind of, my fate's going to be determined pretty soon on those anyway. But for now, I haven't felt the need to sell them immediately. Okay. Excuse me. In terms of trade ideas. So an asset that we haven't really done anything for a while is nat gas. So we look at nat gas. We've been kind of purposely sitting on our hands on this. We've been asked a few times, is it time to buy? Is it time to buy? And we've kind of managed to steer clear of it, right? So whilst I did do a little bit of tactical futures trading when it hit 350, which was a big support level for me, I flipped out of that pretty sharpish and got out the way, which was good because then it went on to test this 2.5 level, right? If we go all the way back, a couple of years, this is quite a decent support level. So we would expect some sort of reaction to come off this level. If we look at the moves it's had in 50 days, it is the largest drop, 65.5% in natural gas in 50 days since 1994. So it's a pretty brutal move, right? Now, we are seeing, this is a weekly chart, but it also applies on the daily chart. We are seeing some bullish divergence on the momentum indicator, and we are at a key level in terms of technicals. So I do think the setup is there for a bounce. Who knows how long it's going to last? But there is clearly the setup there. So the way, how am I playing that? Well, similar to what we did once before on nat gas, or certainly a trade idea that we put out. Can't remember if we executed it or not. But basically, looking at the dashboard, you can see here, sell put spreads are kind of screening as the trade. Vol's relatively still elevated up here at 91. It's realizing not a lot at around 60 something. So the positive vol carry there tells me I want to probably sell options. The fact that we're down here in very oversold territory, obviously I want to buy delta. So how do I sell options and buy delta? Well, obviously I sell puts. How do I not kill myself? I don't sell outright puts. I sell put spreads just in case this goes wrong. So the idea being that, yeah, we are kind of to some extent catching a falling knife, but we're doing it safely. So that there's some protection around that blade. So we're not going to get our fingers completely chopped off if we do that. So that's kind of the trade, selling put spreads on UNG, which is the nat gas ETF. What strikes would I choose? So looking at this, okay, that's it for today. To have a little think about that, whether you're brave enough to dip your toes into nat gas, but if you want to do it safely using options, that's the way to do it. All right, thanks for listening, guys. I'll catch you all tomorrow.